Hi, my name is Dan Toleman, and I lead Wood Mackenzie's LNG content in Asia. Today, I'm going to talk to you about the war in Ukraine and the impact it's had on the LNG industry. I'll start with demand, I'll then go into what supply comes next, and I'll link it back to what it means for PNG. The Russian invasion of Ukraine has had a dramatic impact on gas and LNG markets. I think it's fair to say that European buyers will never rely on Russian gas again. Throughout this presentation, I'm going to use our forecast that was complete in March and talk to you about how the world has changed since then. So that forecast, we assumed that Russian gas would be delivered to Europe at contracted levels. Now we know that it's far below this, as we've seen 10 contracts either be terminated or suspended. Now these Russian volumes will be replaced by LNG, and as a result, we see prices very high at the moment, and they're also very volatile. There's also a big push for more regas infrastructure so that European buyers can gain access to LNG and reduce their reliance on other gas. And a lot of these projects are moving forwards and they'll start up around 2024. Before I get into that, I'd like to start with 5 key lessons from the crisis. The first lesson is that the world remains reliant on hydrocarbons for energy. About 80% of our energy needs come from hydrocarbons at the moment. The second lesson is that the West can live without Russian hydrocarbons, but it will hurt. Prices will be high and they will be volatile, and economic growth may be slower than it otherwise would have been. The third lesson is this decade is going to be a really good one for E&P players. Cash flows are going to be strong, especially for those involved in LNG. The fourth lesson is actually it's going to be inflation and supply chain issues that have the biggest impact on the E&P sector. Projects are going to be delayed and there is a real risk of them overrunning their budgets. The last lesson is that operators need to keep their eye on the prize and they need to make sure that decarbonising the industry is front of mind, such that gas and LNG maintain its role through the energy transition. Now all eyes are on Europe at the moment as these buyers look to remove their reliance on Russian gas. What we're seeing is both European and Asian buyers tugging at the same blanket, and as a result of not too much supply growth and European buyers demanding a lot more LNG, prices have gone up and we've seen price-sensitive buyers in Asia reduce their LNG demand. So we see in the chart on the left, European LNG demand has increased and we've seen Asian demand fall. If we go to our market balance, there's a couple of key takeaways. The first is in the near term, the market is going to be tight. So I expect prices to be high and volatile for the next few years. If you assume that the conflict winds down, prices may fall a little bit, but they're still going to be elevated through the middle of the 2020s. And I believe going forwards after that, prices are going to remain around the $10 mark because we're starting to see a higher marginal cost for LNG as some of the low-cost Russian projects are no longer going to move forwards. In terms of LNG demand, it is all about Europe in the near term. However, after that, it's going to be about return of demand in Asia. And if I'm taking a project forwards, my focus is going to be on Asian buyers and assuming that I can deliver volumes for the next 20 or 30 years into Asia. Now, this forecast was complete in Q1. The world has changed a little bit and we saw those 10 contracts terminated. So there's a couple of things that Europe can do to reduce its reliance on Russian gas. The first is reduce its gas demand and do this by either renewables, biomethane, and that would be one scenario. In our base case, we assume about 60 million tonnes of new projects are needed by 2030. Under a demand reduction scenario, we would see that being around the 20 to 30 million tonnes. In the alternative, European buyers could go towards LNG, and this is the way that I think they're going to move. They're going to take LNG regas projects forwards, and what we'll see is a response from the supply side, and we'll see a lot of new LNG supply sanctioned. And under this scenario, we could see a need for around 100 million tonnes of additional LNG projects by 2030. Now, my gut feel is it's somewhere between the 60 and 100 million tonnes that the world's going to need by 2030. And then longer term, we're going to need to see more projects meeting Asian demand, which I expect will rebound and continue to grow as Asian countries look to go for a gas plus renewable story rather than diverting to a coal plus renewable story, which would see much higher emissions. So to meet this longer term demand, what projects are moving forwards? Where we're seeing a lot of momentum is the US. A lot of contracts are being signed, and this is underpinning developments and allowing them to move towards FID. So far this year, we've seen FIDs from Corpus Christi Stage 3, as well as the first phase of Plaquemines. We've also seen a couple of smaller scale fast LNGs that have been sanctioned. In addition to this, there are a number of other projects that have had commercial success and are likely to move forwards either this year or early next year. Outside the US, Qatar, we expect Northfield South to be sanctioned either this quarter or next quarter. And then there's a number of smaller scale projects that are moving forwards that also could take FID in the next 12 months. PFLNG 3 is one of those. We're closely watching the progress of Papua LNG, and we're hoping it can be sanctioned before the end of next year. Another thing to note on all of these projects is how front of mind reducing emissions are. You can see by the green clouds the number of CCS projects that are included. Also, operators are looking at other ways to reduce their emissions. So whether that's capturing methane, reducing venting and flaring, electric drive, operators are considering all of the options they have to reduce their emission profile to make LNG as low intensity as possible. Now, just to finish up, the one thing is there's plenty of upside to our forecast. So we assume 60 million tonnes of projects will be sanctioned this year and next year. And you can see that there is 200 million tonnes of possible projects moving forwards. Now, I'm not saying that 200 million tonnes will be sanctioned. However, I think there is a real opportunity that we could see over the next 2 years, 100 million tonnes be sanctioned, maybe even slightly more than that. And that's really being underpinned by the contracting momentum that we see for US LNG. Now, remembering that the demand growth longer term is going to be in Asia, there's one other advantage that projects like Papua LNG have, and that is there's limited supply moving forwards east of the Suez. So yes, you've got the Qatari volumes, but these will be flexible and can be diverted between Europe and Asia. But other than that, there isn't a lot of volumes moving forwards east of the Suez. And I think this is a real advantage for projects in Southeast Asia and Australia. So what do all of these projects mean moving forwards? Well, we actually see prices being high for the next 5 years. So through this period where there was limited FIDs and delays due to the coronavirus pandemic, we're going to see low year-on-year supply growth. So that means prices are going to be high through 2026 before we see this next wave of supply, when we see about 100 million tonnes of new supply coming to the market. Now, this supply is the FIDs that were taken in 2019, as well as the project sanctioned last year and our expectation of the projects that will move forwards this year and early next year. Now, what does this new supply mean? Well, there's a couple of different scenarios that we could see happening here. In a low demand scenario, if all of this supply comes to the market on time, we could see a period of soft prices, and that would have impacts for projects that are moving forwards, and they would need to make sure that they are robust from a cost point of view. However, if this supply is delayed and we see quite a quick rebound in demand, or if Europe goes for that real LNG scenario and they look to build out the regas capacity, we could actually see prices being quite strong throughout the remainder of this decade, especially if we see issues with the supply chain and LNG projects delayed. So I think we could see quite strong prices moving forwards, but there certainly is a risk of oversupply if our demand is reduced. Now, what does this mean for PNG? Well, the next 2 years we expect prices to be high. We also foresee very strong LNG production from the base project. So over the next 2 years, we're forecasting 8.7, 8.6 million tonnes per annum. This means that there's going to be a number of spot cargoes delivered into a market that desperately needs LNG. So I think that's good news for the market, as well as good news for the partners of the base project. And longer term, what does it mean for PNG? Well, it means that there's a market that needs more LNG projects, especially east of the Suez. So we expect Papua LNG to go forwards, and we're watching for it to be a cost and carbon effective project. We believe it is price competitive and emission competitive versus other projects out there. We'd like to see a stable fiscal and government environment to help these projects proceed. And we'd also like to see alignment from the partners. And we hope that FID can be achieved as early as H2 next year. So to sum up, for the next couple of years, all eyes are going to be on Europe. I think we're going to see high prices and volatile prices over the next 2 years. And we're going to watch as those European buyers look to wean themselves off Russian gas and whether there's regas infrastructure taken forwards and how that plays out. We believe that Asian buyers are largely going to remain out of the spot market over this time, and this will be driven by high prices, especially those price-sensitive countries. They'll look for other sources of energy, and they'll perhaps stay away from spot LNG if it is plus 30 or plus 40 US dollars at MMBTU. A large portion of the supply will come from the US. Other supply will come from Qatar, which really does open up an opportunity for projects east of the Suez. So we do expect to see Papua LNG going forwards, and we think there will be a push to develop more supply that can easily access the Asian markets going forwards. In PNG, I'm watching for continued strong performance of the base project. I think there's an opportunity for a number of spot cargoes to be delivered into a market that desperately needs it. And then longer term, what I'd like to see is a competitive expansion project followed up by backfill to keep the base project full and to ensure that there's robust LNG production for the next 20 to 30 years. Thank you.